Good morning, students. As you all know that we start discussing about the macroeconomic chapter, that is chapter number 10, government budget and the economy. So what are the learning objectives in this topic? We study about the budget, its meaning and features, objectives of the budget, structure and components of the budget, budgetary receipts, budgetary expenditure and budget deficit. So students, as you see in the picture, said that the government budget and economy, the picture in the presentation is of the finance minister Srimati Nirmala Sitharaman. Now students, what are the highlights of this picture? That in 2014 Prime Minister's government, Mrs. Nirmala Sitharaman, present the bill in the traditional red cloth from the very long years. Now, origin of the budget, as we all know that the French word boget means the leather bag that is used instead of budget. So, bag used by the British Chancellor to keep his paper to be presented to the Parliament. Present sense of the term was used for the first time in 1853. Now, a government budget is an annual statement of estimated income and expenditure of the government during a fiscal year. So we have the different types of the budget. We have the balanced budget, we have the unbalanced budget, surplus budget and deficit budget. Now what do you mean by the balanced budget? So whenever we have the estimated receipts is equal to the estimated expenditure, so we can say that it is the balanced budget. Now, unbalanced budget again is of two types. Sometimes we have the surplus budget and sometimes we have the deficit budget. Now, how do we have the surplus budget? Whenever our estimated receipts are greater than our estimated expenditure, we are incurring the surplus budget, and the vice versa, that is the deficit budget. Whenever estimated expenditure is greater than our estimated revenue, we have to suffer the deficit budget. Now, along with this, we have some features of the budget. So, budget is what? It is an estimated and not an actual statement. Okay, students, we are talking about the estimated and not the actual. Estimated means it may be, if we are talking about in thousands, the budget may be in lakhs, or if we are talking about the thousand, the budget may be in hundred. So, it is prepared annually, that is in the fiscal year from 1st April to 30th March. It is a constitutional requirement to present the budget before Parliament. So revenue and expenditure are planned according to the objectives of the government. So budget impacts the economy through aggregate fiscal discipline and resource allocation. Now as we are talking about the features and the meaning of the budget, now it's time to discuss the objectives of the budget. So as you see in the slide, what are the objectives of the budget? So number one objective is the economic growth. As we all know, that is the growth of the economy is the ultimate objective of the budget. So government through its fiscal policy targets to inject sufficient resources by encouraging savings and investment, so that this will further enhance capital formation and level of production, causing rise in national income and economic growth. Next is the economic stability. Economic stability function is also known as the stabilization function, as the government brings some policy measures to control the level of aggregate demand. So using its revenue and expenditure policy, the government ensures economic stability in the economy. Next, managing state-owned enterprises. As we all know that what is the objective of the government, that to inculcate the habit of savings and investment in the economy. So by encouraging public sector enterprises, the government wants to bring economic stability in the economy. Then proper allocation of resources, that it refers to change in direction of resources from one use to another, and the government seeks to reallocate resources with a view to balance the goals of profit maximization and social welfare. So unlike private enterprises, government targets social welfare along with profit motive. So production of goods which are injurious to health, like wine or liquor, is discouraged through heavy taxation. On the other hand, production of socially useful goods like khadi is encouraged through subsidies. So if private sector does not take initiative in certain activities, government directly controls them, like water supply, sanitation and etc. So students, we as we all know that this function is also known as the allocation function. So one of the most important function that is lagging behind, that is reducing inequalities in income and wealth. So the government use fiscal instruments of taxation and subsidies to improve the distribution of income and wealth in the economy. High taxes can be imposed by the government on income earned by rich and also on goods consumed by them in order to reduce their personal disposable income. Also, in order to increase disposable income of the poor, government can provide free service of education, health, etc. So this is about the objectives of the government. Next, as I already discussed, that economic growth is government allocates resources for various development and welfare activities in its budget. Funds are allocated for the defense of the country. Resources are allocated for education and health sector. Resources are allocated for development of various sectors of the economy. Balanced allocation of resources helps in balanced economic growth, and backward areas are given more resources. So, what is the role of the government in allocation of resources? That how government helps in allocating the resources? So the government can impose heavy taxes on dangerous and harmful goods. This will discourage their production, and the government can provide subsidies to encourage the production of essential commodities. Heavy tax can be imposed on luxury goods so that their production can be discouraged. So economic equality, and so the government may impose heavy tax on rich men's income and luxury goods like the income tax. Progressive rate of taxation can be followed. Poor men's income and necessary goods may be exempted from taxation. The money collected from the rich can be used for various welfare programs for the poor people, and food can be supplied at low rates as well as at subsidized rates. Education and health service can be developed. Next is the economic stability. So economic stability can be achieved by controlling inflation and deflation. Now, inflation is whenever the general price level of the goods can be increased, and deflation means whenever the agri demand falls short. So during inflation, the government can prepare a surplus budget, so taxes can be increased and expenditure can be reduced. This will reduce money supply and help in controlling inflation. During deflation, the vice versa will be there. The government can prepare deficit budget, taxes can be reduced and expenditure can be increased. This will increase money supply in the economy. Now, management of public enterprises, how that is allocation of funds for the public sector enterprises is done through the budget. And now we are talking about the structure as well as the component of the budget. So as you see in the picture, government budget is of two types: revenue budget and capital budget. If you're talking about the revenue budget, we have the revenue receipts and revenue expenditure. If we're talking about the capital budget, we have the capital receipts and capital expenditure. So revenue receipts again bifurcated into two, that is the tax revenue and non-tax revenue. As we all know that tax is the ultimate source of revenue for the government, and tax is of two types: direct tax and indirect tax. I hope you can better understand through while going through the book. Now, revenue receipts. Revenue receipts, first of all, are those receipts that does not cause liability to the government, and revenue receipts are those that does not lead to reduction in assets of the government. So, if we are talking about revenue receipts, are those estimated receipts of the government during the fiscal year which does not affect asset or liability status of the government. Then we are talking about the capital receipts. So capital receipts are what? Capital receipts that cause liability to the government, and these are lead to reduction in the assets of the government. So we can say that capital receipts are those estimated receipts of the government during the fiscal year which affect asset and liability status of the government. So these create corresponding liability for the government through borrowings, and also leads to reduction in the assets of the government, that is disinvestment, recovery of loans. So if we are talking about capital receipts, so it consists of borrowings from within the country and abroad. Other receipts like proceeds from disinvestment, that is when the government sells off its shares of public sector enterprises to private sector, and recovery of loans from state and other debtors. Next is talking about the revenue expenditure. So revenue expenditure is that expenditure that does not reduce the liability of the government, and it also does not lead to creation of assets. Next is the capital expenditure. So expenditure that reduce the liability of the government, and expenditure that leads to the creation of assets, as we all know about that. So receipts on the sale of public sector undertaking, it is a capital receipt. So these are the some examples that receipt from the sale of shares of public sector undertaking is what? It is a capital receipt because it has a long term effect, because it results in the reduction of assets. Next is the borrowing from the public. So students, you must think about whether it is a capital receipt or capital expenditure. So this is a capital receipt because it increases the liability of the government, and profit of sale of profit from public sector undertaking, it is a revenue receipt because profit does not create a liability or reduce the assets of the government, and if we are talking about the disinvestment, so disinvestment is a capital receipt because it reduces the asset of the government by selling off the shares of public sector enterprises to the private sector enterprises. Now the custom duty, this is also one of the revenue for the government. It is a revenue receipt. It does not create a liability nor reduce assets too. So the construction of building, if we are talking about, so it creates an asset for the country. So it is a capital expenditure. And if we are talking about the interest payment, subsidies and grants given to state, these do not create assets nor reduce the liability, so they come under revenue expenditure. And the last one is the income tax, excise tax, fines and duties. As we already discussed in the above slides, that the tax is the ultimate source of revenue for the government. So these are the revenue receipts because these do not create a liability or reduce the assets of the government. I hope this is all clear to you, students. But next we are talking about the sources of government revenue. So there are two sources. That number one is the tax revenue, number two is the non-tax revenue. And tax revenue, students, what do you mean by a tax? Tax is a compulsory payment made by an individual, household or a firm to the government without anything corresponding in return. So we can say that it is a compulsory payment, that is, if tax is imposed by the government on a person, he has to pay it. It is a compulsory payment. So payment of taxes is the personal responsibility of the person. Taxes are imposed legally, that is according to the law of the land. The revenue received through taxes is spent for public welfare, and there is no proportional relation between the tax and the social benefit offered correspondingly. Now tax is of two types, the direct tax and indirect tax. If we are talking about the direct tax, so direct tax are those taxes whose final burden falls on that person who makes a payment to the government. Here the incidence and impact of tax lie on the same person. I am focusing on the word incidence and impact, that lie on the same person, that is the income tax, wealth tax, property tax and gift tax. Now land revenue and registration tax, this is also the direct tax because a person who owns the land is liable to pay the tax. And property, profit and income tax, this is levied and paid on by the same individual. Next is the indirect tax. So students, indirect tax are the taxes which are paid to the government by one person, but their burden is borne by another person. So the incidence and impact of the tax lie on different person. We have the example, that is the custom duty or the consumption tax on consumption and production of goods and services, as well as the GST, that is the latest example. Now the non-tax revenue, if we're talking about the non-tax, so we have the dividend tax, receipts from sale of government commodities, and fines and penalties, principal and interest payment, royalty and sale of fixed assets, and the income from public enterprises, forfeiture of bonds, interest on loan. These are some of the sources of non-tax revenue, which are the ultimate source of revenue for the government. Now sources of public expenditure, that is where the public expenditure allocates. So public expenditure refers to the money spent by the government for various purposes during a financial year. So public expenditure is classified into plan and non-plan expenditure. As you see in the slide, that is a plan expenditure and non-plan expenditure. Now if you're talking about the plan expenditure, what is the plan expenditure? So it refers to the amount spent on activities included in the 5-year plan. So students, in 1951 we started the 5-year planning, that is the first 5-year plan is from 1951 to 1956. And who prepared the 5-year plan? This is the duty of the Planning Commission of India. Now the Planning Commission changes to Niti Aayog. So thus it shows a central plan allotment for various projects, programs, schemes, and the central essence for the state and the union territories. If you're talking about the flagship, these are the plan expenditure. Now the non-plan is refers to the money spent on the items which are not included in the 5-year plans but are included in the budget. For example, interest payments, defense revenue expenditure, subsidies. These are the non-plan expenditure for the government. So students, both plan expenditure and non-plan expenditure are divided into revenue expenditure and capital expenditure. So they are further subdivided into development expenditure and non-development expenditure. So developmental expenditure refers to the money spent on those items which are directly related to economic and social development of the economy. For example, we are talking about the expenditure on capital assets, infrastructure, then railways, post, education, health, transport, communication, industries. This is about the development expenditure. And non-development expenditure, it refers to the money spent on those items which do not contribute to the development. For example, expenditure on defense, interest payment, old age pension, unemployment allowances, and justice, grants to state government, and etc. So many. Now comes to the budget deficit. This is the last topic of the chapter. So budget deficit, what do you mean by a deficit? Whenever we have we incur expenditure more than the revenue, we are facing the situation of budget deficit. So again students, budget deficit is of 3 types: revenue deficit, fiscal deficit, and primary deficit. So in detail, budget deficit is defined as the excess of total estimated expenditure over total estimated revenue including borrowing. So when the government expenditure exceeds its revenue, it incurs a budgetary deficit. So revenue deficit. Yes, so revenue deficit. So if revenue deficit is more than revenue receipts, it is called the revenue deficit. So this deficit occurs in revenue budget of the government. So revenue deficit is concerned with the revenue expenditure and revenue receipts of the government. Government revenue is insufficient to meet the expenditure or normal functioning of the government departments and provisions for various services. Next is the fiscal deficit, and fiscal deficit again it refers to the excess of total expenditure over total revenue receipts and capital receipts excluding borrowing. So this is basically refers to the excess of total expenditure over total receipts excluding borrowings during the given fiscal year. Now what are the implications of fiscal deficit? So the implications includes the debt trap, foreign dependence, causes inflation, financial burden for future generations. And how do we overcome it? The main sources: borrowings and deficit financing. Okay. Now the last one is primary deficit. So it is defined as the fiscal deficit less interest payments. So to calculate the amount of borrowings on account of current expenditure exceeding revenue, we need to calculate the amount of the primary deficit. So it is done by subtracting interest from fiscal deficit. Now the implications of primary deficit includes that it is defined as a fiscal deficit minus interest payments on various borrowings. Therefore it indicates the amount of borrowings required to meet the expenditure other than interest payments. Now how the government reduce the primary deficit? So primary deficit indicates borrowing requirements of the government to meet deficit other than interest payments. Therefore effort should be made to reduce the fiscal deficit. So to reduce fiscal deficit, interest payment should be reduced through repayment of return loan as far as possible. So students, this is all about the chapter the budget, government budget, and the economy. Now as per board exam point of view, so this chapter consists of 6 marks only, and the numerical is will be seen in the exams during this chapter. So best of luck for further learning. Thank you.